Welcome to Ainslie News. It's Wednesday, 17th of June, 2020. Today we're talking the Fed zombification. Never thought we'd put those two words together. In 2018-19, the US Fed, thinking everything was awesome and they could withdraw the free money heroin from the addict, tried so-called quantitative tightening, or QT. We all know now how that ended, and the response since then has been one for the history books. Check out this next chart. Total Fed assets. A little bit of an increase leading into 2020 there. First we saw not QE, where they supported the rupturing repo markets with printed money, stabilizing share markets. Then the pandemic hit, purely the prick the bubble was waiting for. And they reverted not just to outright QE, but QE unlike we've ever seen before. And now they have formalized, though not previously announced, that they will buy more corporate debt and ETFs. But whilst the market knew Santa was coming down the chimney, they didn't know it was going to buy individual corporate debts rather than baskets through ETFs and the like. This was a game changer and takes the Japanification of the US to a whole new level. As we've reported earlier, the Bank of Japan is now the biggest owner of ETF shares in Japan, has monetized all new sovereign debt issuance, and is a massive owner of corporate and mortgage-backed debt. The Fed maintains it does not monetize debt in the same way. However, the numbers suggest that it is just not so. As we talked about last week, US debt has exploded over $26 trillion, and Trump just announced another $1 trillion for infrastructure. So how did it get there? US Treasury debt increased by $2.86 trillion. Coincidentally, the Fed expanded its balance sheet, buying US Treasuries by $3 trillion. We've also seen the latest figures this week showing foreign holders reduced their US Treasury holdings in the same period. Check out this next chart. Fed balance sheet versus Treasury debt. Pretty staggering increase. US corporate debt, and particularly the eroding quality of its towards junk, is still identified by many as the key risks remaining in the market as we face the biggest recession of all time. The growing trend of so-called zombie companies, or those with debt servicing costs higher than profits, is disturbingly on the rise. Shown in this next chart, US rising share of companies with debt servicing costs that are higher than profits. I don't even know how that can exist, but moving on. That the Fed has stepped up to the plate is huge and begs the question of where does this end? Fed Chair Powell testified before the Senate last night, and as Peter Schiff tweeted, Powell just admitted that the Fed's only plan to shrink the exploding balance sheet is to simply stop making it larger while the economy grows, thus only shrinking the balance sheet as a percentage of GDP. So there's no plan to ever attempt to actually shrink the balance sheet. Of course, even if you get past the fixed debt issue, this relies on strongly growing GDP to not become a zombie of its own. We talked about the OECD projections recently, and the World Bank recently gave further insight into the enormity of this recession that markets somehow seem relaxed about. From Weiss ratings, we don't have economic data from the 14th century, when the Black Death swept through Asia, Europe, and Africa. We certainly don't know much about the great floods that struck the Middle East and Central Asia thousands of years ago. But we do have reliable GDP numbers going back to the 1800s. And based on that data set, the World Bank has just issued a very startling analysis. In 2009, the Great Recession reached 61.2% of the world's countries. In 1931, the Great Depression impacted 83.8%. In other periods, the terrible 1880s, the World War I and World War II, the collapse rarely reached more than 60% of all the countries. But 2020 is the worst of all. The economic depression sweeping the globe is the most widespread in recorded history. A whopping 92.9% of the world's countries are sinking into the economic morass. That's from the World Bank. That's one alarming fact. And here are four more. The US, worse than the Great Depression. The US economy will suffer a steeper plunge this year than it did in the worst year of the Great Depression. In 2020, the World Bank expects GDP to contract by a shocking 6.1%. Back in 1932, it sank only by 5.3%. Japan, no better than the US despite mild pandemic. Despite the fact that the pandemic in Japan has been far less severe, the depression will be just as bad, with GDP down the same, 6.1%, just like the United States. Europe, even worse. The European economy, which was already teetering before the pandemic, will suffer the most of all. GDP will be crushed with an unimaginable decline of 9.1%. Recoveries in 2021, anemic. The combined GDP of the US, Europe, and Japan will sink 7% in 2020, but will only recover by 3.9% in 2021. All this represents the most current non-partisan forecast from any major government body. So sorry folks, but two things become very, very apparent. We are nowhere near the Fed easing off further expansion of its balance sheet through buying US treasuries, mortgage-backed securities, and now US corporate debt and ETFs directly. We are also clearly nowhere near any magical surge in GDP to make that somehow look like a good investment on their balance sheet. This is all just desperation playing out by the only hope left. Sven Henrik of Northman Trader summarizes this setup. The Fed has created a full-on gambling casino, and the gamblers have moved in and are pulling the buy triggers non-stop. The Fed is not saving the economy, it's zombifying it, and in process of inserting itself ever deeper into markets, the Fed is itself becoming too big to fail. The Fed losing control over the asset bubble is now the biggest risk factor in the economy. A rescue model that relies solely on ever higher stock prices, ever more divergent from the underlying economy, creating an ever larger wealth gap in the process. It's a spiral out of control that is masking what's really going on. The structural economy is circling the drain, and zombifying the economy will only clog it up with dire consequences to come. Consequences for now, as markets are still busy chasing every liquidity headline. And that's news for today.